Scared to invest? You're not alone, but the stock market isn't as complicated as it seems. With a bit of knowledge and a clear plan, anyone can start building wealth. Welcome to Finance Made Simple. Let's break down the basics. In this video, I'll guide you step by step through your first investment. We'll cover what stocks are, how to pick a broker, basic analysis, risk management, and building your first portfolio. By the end, you'll feel confident to take your first steps. Grab a coffee and let's get started. What is a stock? Simply put, it's a small piece of ownership in a company, like holding a tiny slice of a giant pie. When you buy a share, you become a part owner and share in the company's success. Companies sell shares to raise money for growth. If the company does well, your share's value can rise. If it struggles, your share's value can fall. That's the risk and reward of investing. Stocks are bought and sold on stock exchanges, giant marketplaces where prices change based on supply and demand. The New York Stock Exchange and Nasdaq are two of the most famous. You'll also hear about indices like the S&P 500 or Dow Jones. These track groups of stocks and show how the market is doing overall. Remember, investing isn't gambling. Stocks represent real ownership in real businesses. When you invest, you're betting on companies growing and creating value over time. Understanding these basics is your foundation. Next, let's see how to buy your first stock and start your investing journey. So how do you actually buy stocks? You need a brokerage account. A broker is a licensed company that buys and sells stocks for you. Today, online brokers make it easy and affordable. No more calling someone on the phone. Look for a broker with zero commission fees for stocks and ETFs. Watch out for hidden fees, like maintenance or inactivity charges. Choose a broker with no or low minimum deposit requirements. Make sure the platform is user-friendly and easy to navigate. Many brokers offer demo accounts. Try before you commit real money. Good research tools and educational resources are a plus, especially for beginners. Customer service matters. Check reviews to see how helpful they are. Popular beginner-friendly brokers include Fidelity, Schwab, Vanguard, Robinhood, and Webull. Compare a few before deciding. Opening an account is simple, just like opening a bank account online. Provide your info, answer a few questions, and fund your account. You'll be ready to invest in minutes. The right broker makes your investing journey smoother. Let's move on to how to pick what to invest in. Now, how do you decide what to buy? That's where analysis comes in. There are two main approaches: fundamental and technical analysis. Fundamental analysis looks at the business itself, its financial health, management, and industry. You'll check things like earnings, revenue, debt, and profit margins. The goal: find companies worth more than their current stock price. This is a long-term approach, favored by investors like Warren Buffett. Technical analysis, on the other hand, focuses on price charts and trading patterns. It's about spotting trends and predicting short-term moves. Technical analysts use tools like moving averages and support on resistance levels. For beginners, fundamental analysis is usually a better starting point. It helps you understand what you're buying. Technical analysis can be overwhelming and risky if you're new. You don't need to master charts right away. Many beginners start with broad market ETFs, so deep analysis isn't always necessary. Know that both approaches exist, and you can blend them as you learn. Focus on understanding company basics first. As you gain experience, you'll find your own style. Next, let's talk about managing risk, so you can invest with confidence. Smart analysis is only half the battle. Risk management is the other. Risk management is absolutely crucial for anyone venturing into the world of investing. It's the cornerstone of protecting your hard-earned money and setting yourself up for long-term success. It's not something you can afford to skip. Don't skip this step. Think of it as your financial safety net, ensuring you're prepared for any unexpected market turns. All investing inherently involves risk. It's part of the game. But the good news is, you can manage it wisely and minimize potential losses. It's about making informed decisions and understanding the potential downsides before diving in. Rule number 1, don't lose money. This might seem obvious, but it's the guiding principle behind all smart investment strategies. Rule number 2, remember rule 1. Never forget the importance of protecting your initial investment. Diversification is your best friend in the world of investing. It's a classic saying for a reason. Don't put all your eggs in one basket. Spread your money across different companies, both large and small, and across various sectors of the economy. Broad market ETFs or exchange traded funds make diversification incredibly easy, especially for beginners. They offer instant exposure to a wide range of stocks with just one investment. Position sizing matters significantly. Be careful. Don't put too much of your capital into any single stock. A good rule is to allocate no more than 5 to 10% of your entire portfolio to any one individual company. Know your own personal risk tolerance. If the thought of market drops keeps you up at night, causing you stress and anxiety, then it's a clear sign you should invest more conservatively, opting for lower risk investments. Avoid emotional investing at all costs. Don't let fear or excessive greed drive your investment decisions. Stick to your predefined investment plan and try to ignore the constant short-term market noise and sensational headlines. Set realistic expectations for your investment returns. Remember, investing is a long-term game requiring patience and a long-term perspective. It's definitely not a get-rich-quick scheme. Only invest money that you absolutely won't need for at least several years. Always keep your emergency fund completely separate from your investment accounts. The market can be incredibly volatile, especially in the short term. By diversifying your investments, sizing your positions wisely to manage risk, and consistently staying disciplined with your investment strategy, you'll significantly protect your capital from major losses. Smart risk management ultimately leads to a much smoother and far less stressful investing journey overall. Play smart, not just hard, when it comes to your investments. Now, let's put all of these principles together and start building your very first investment portfolio. You're almost ready to take the plunge and start investing. Let's build your first portfolio. It's easier than you think. We'll break it down step by step so you can start growing your wealth today. Start simple and small. Focus on learning, not perfection. Don't worry about picking the perfect stock or timing the market. The most important thing is to get started and learn as you go. For beginners, broad market ETFs are a great start. They give you instant diversification at low cost. An ETF is a basket of stocks. Buy one share, get instant diversification. This reduces your risk compared to picking individual stocks. An S&P 500 ETF gives you exposure to 500 top US companies. Or try a total stock market ETF for even broader coverage. This approach bets on the long-term growth of the whole market. No need to pick winners. You're investing in the market, not just one company. Use dollar cost averaging. Invest a fixed amount regularly, no matter what the market's doing. This helps you buy more shares when prices are low and fewer when they're high. It smooths out your purchase price and removes emotion from investing. To start, pick your broker, fund your account, and buy your chosen ETF like VOO, IV, or SPY. Many brokers let you buy fractional shares, so you can start with just a few dollars. The key is to start, even with a small amount. Let your investments grow over time. Your first portfolio doesn't have to be perfect. Adjust as you learn and gain experience. Build good habits, invest regularly, and think long-term. Investing is a marathon, not a sprint. Be patient and stay focused on your goals. The power of compounding helps your money grow over the years. A simple, diversified ETF portfolio is a solid foundation for building wealth. Anyone can do this. Investing is for everyone who wants a better future. Ready for your first investment? You've got this. That's it. 5 simple steps to start your stock market journey and begin building your financial future. We covered what stocks are, how to pick a broker that suits your needs, basic analysis, risk management, and building your first portfolio. The key: keep learning and expanding your knowledge. Start small, diversify, and think long-term. The stock market is a tool for steady wealth building, not quick riches. Don't let fear hold you back. Take your first step today. If you found this helpful, like and subscribe for more helpful guides. Thanks for watching. See you in the next video.